Imagine waking up one morning and hearing a terrifying headline. China is done buying America's debt. For decades, China has been one of the biggest foreign holders of U.S. Treasury securities. So the obvious question is almost impossible to avoid. If China walks away from U.S. debt, who is going to buy the next $1 trillion? And with America's federal debt now approaching the $40 trillion psychological milestone, this question is no longer just about China. It is about whether the world can continue absorbing America's enormous borrowing needs without demanding significantly higher interest rates. But there is an important fact that often gets lost in the headlines. China has not simply announced that it is abandoning U.S. Treasuries. In fact, the latest official Treasury data available as of August 2026 show something much more complicated. The U.S. Treasury's most recent monthly international capital release, covering May 2026, showed that foreign investors were still buying large quantities of U.S. securities. Foreign residents purchased $262.8 billion of long-term U.S. securities in May alone, including $246.8 billion purchased by private foreign investors. So the real story isn't that America suddenly needs to find one replacement for China. The real story is much bigger. Who is actually financing America? And what happens if one of the largest buyers gradually disappears? To understand that, we first need to understand what America's debt really is. When people hear the phrase $40 trillion in debt, it sounds like America owes $40 trillion to China, Japan, or some giant foreign bank. That's not how it works. The United States Treasury has issued an enormous quantity of Treasury bills, notes, and bonds to finance federal spending. Those securities are owned by a huge collection of investors. Some are American, some are foreign, some are governments, some are pension funds, some are banks, some are insurance companies, some are investment funds. And one of the biggest players is the Federal Reserve. The foreign share is important, but it is only one part of the market. This distinction matters enormously, because if China stopped buying new treasuries tomorrow, the United States would not suddenly discover that nobody owns its debt. America would still have one of the deepest government bond markets in the world. The problem would be different. The problem would be finding enough buyers for the new debt being issued, while also refinancing old debt as it matures, and that's where the numbers become eye-opening. According to the Congressional Budget Office's February 2026 outlook, the federal budget deficit is projected to reach approximately $1.9 trillion in fiscal year 2026. The CBO projects that debt held by the public will rise from about 101% of GDP in 2026 to approximately 120% of GDP by 2036. And the cost of servicing that debt is becoming increasingly important. The CBO projects net interest outlays of about $1 trillion in 2026. By 2036, that figure is projected to reach roughly $2.1 trillion a year. In other words, America isn't simply borrowing money. It is borrowing money to finance a government whose existing debt is itself generating an enormous and growing interest bill. Now bring China into the picture. China has been reducing its treasury exposure for years. The latest detailed official annual Treasury survey, covering June 2025, showed mainland China holding approximately $1.279 trillion of U.S. securities overall. Of that amount, roughly $657 billion was in long-term debt securities, and another $344 billion was in equities, with other holdings making up the remainder. But monthly Treasury data suggest China's Treasury holdings have continued to move lower. That is important because China does not need to dump every treasury it owns to reduce its importance as a buyer. It can simply stop adding to its holdings. It can allow bonds to mature. It can redirect foreign exchange reserves into other assets. It can increase gold holdings. It can buy European or Asian securities. Or it can simply maintain a smaller allocation to U.S. government debt. And that is a much more realistic scenario than the dramatic idea of China waking up one morning and selling hundreds of billions of dollars of treasuries at once. In financial markets, gradual changes can sometimes be more important than spectacular ones. Think about it this way. If you have a company that needs to borrow $2 trillion every year, and one of its major lenders says, "I won't provide as much money as I used to," the company doesn't necessarily collapse. But it needs to find somebody else, and that somebody else may demand a higher interest rate. That is the key issue with China. China does not control whether America can borrow, but China can influence the price at which America borrows, and interest rates are the price of borrowing. This is why the question, who will buy America's debt, is actually a question about yield. If demand for Treasury securities falls, prices tend to fall. When Treasury prices fall, yields rise. And when yields rise, the U.S. government eventually pays more to finance its debt. That higher cost can then feed into the broader economy. Mortgage rates can be affected, corporate borrowing costs can be affected, auto loans can be affected, credit markets can be affected, and the federal government's own interest bill becomes more expensive. But here's where the China story becomes much more interesting. If China stops buying, who steps in? The first answer is Japan. And this is already visible in today's market. Reuters reported in August 2026 that Japan was the largest foreign holder of U.S. Treasury securities, with holdings around $1.14 trillion. That means that when people focus exclusively on China, they may be looking in the wrong direction. Japan is an enormous player, but Japan has its own problems. Japanese interest rates have been changing. Japan has been dealing with a weak yen. Its government has an enormous domestic debt burden, and Japanese investors have to constantly compare the return available at home with the return available from U.S. Treasuries. If Japanese bonds become more attractive, Japanese demand for treasuries could weaken. And if the yen becomes unstable, Japanese authorities may have incentives to manage their foreign assets differently, so Japan can help absorb some of the supply. But Japan cannot be assumed to become America's unlimited replacement buyer. Then there is the United Kingdom. The UK is another major holder of U.S. Treasury securities. And here something very important needs to be understood. Foreign treasury holdings are not always a simple reflection of where the ultimate owner lives. Financial centers such as London, Luxembourg, the Cayman Islands, Ireland, and Belgium can appear prominently in treasury ownership statistics because securities are held through custodians and financial intermediaries. So when you see a country ranking, it does not necessarily mean that the government of that country personally owns every dollar attributed to it. This is one reason the Treasury's international capital data require careful interpretation. America's debt is held through a gigantic global financial network, and that network includes private investors. Which brings us to the most important group of potential buyers, American investors themselves. This is the part that is often missing from dramatic China versus America headlines. The U.S. Treasury does not need foreign governments to buy every new bond. American banks can buy treasuries, American pension funds can buy them, insurance companies can buy them, mutual funds can buy them, money market funds can buy them, households can buy them, investment managers can buy them, and the financial system can absorb huge quantities of government securities. In fact, the U.S. Treasury market exists precisely because there is an enormous domestic and international investor base. So if China disappears from the buyer pool, the first response does not have to be panic. The market can simply adjust. Treasury yields could rise until other investors find the securities attractive enough. That's the market mechanism. Higher yields create a stronger incentive to buy. And that is why the most realistic answer to who will buy the debt may simply be whoever thinks the interest rate is high enough. But there is a catch. Higher yields are not free money for Washington. They are a higher financing cost. And that is where America's fiscal problem becomes dangerous. Suppose the Treasury needs to borrow trillions of dollars over several years. If investors demand even moderately higher yields, the effect compounds as old bonds mature and are refinanced at new rates. America doesn't refinance all its debt at once. Treasury securities mature continuously. New securities replace them. That means higher interest rates gradually spread through the government's debt portfolio. The CBO already expects interest costs to rise sharply over the next decade, from around $1 trillion in 2026 to roughly $2.1 trillion in 2036. And this is happening without assuming that China suddenly dumps every treasury it owns. That's the important point. America's biggest challenge isn't necessarily a Chinese fire sale. It is the combination of enormous deficits, growing debt, and the cost of refinancing that debt. And Treasury borrowing requirements are enormous. In August 2026, Reuters reported that the U.S. Treasury had raised its estimate for third quarter borrowing to $739 billion. For the fourth quarter, Treasury projected another $628 billion of borrowing, assuming an $850 billion year-end cash balance. Think about those numbers. Hundreds of billions of dollars in borrowing in just a few months, and this is new borrowing on top of a debt stock that is already enormous. So if China walks away, the United States isn't looking for somebody to buy the $40 trillion. It is looking for investors willing to absorb the next hundreds of billions and trillions of dollars of issuance, and that distinction changes everything. Now let's talk about another buyer that gets misunderstood, the Federal Reserve. The Fed owns a huge portfolio of Treasury securities. The Federal Reserve's balance sheet was around $6.7 trillion as of March 2026, according to the Fed's own reporting. Its securities holdings include U.S. Treasury securities. As of July 2026, Federal Reserve data showed roughly $4.51 trillion in Treasury securities held outright. So why doesn't the Fed simply buy everything China refuses to buy? Because that isn't a free solution. When the Federal Reserve purchases Treasury securities, it creates central bank reserves in the financial system. Under some circumstances, large-scale purchases can push Treasury yields lower and provide financial market support. That's what happened during quantitative easing. But massive central bank purchases can also have inflationary and financial stability consequences, depending on the economic environment. And the Federal Reserve is not simply an ATM for the Treasury Department. It has a monetary policy mandate and operates independently. In fact, the Fed spent years reducing its balance sheet through quantitative tightening. So expecting the Fed to automatically replace every foreign buyer who disappears would be a major misunderstanding of how the system works. There is another enormous source of demand that is becoming increasingly interesting: money market funds and the broader cash management industry. When an investor wants somewhere relatively safe to park cash, U.S. Treasury bills are extremely attractive because they are liquid, short-term, and backed by the U.S. government. That means that Treasury bills can find buyers even when long-term bonds are under pressure. And the investor base isn't just governments. It is financial institutions managing trillions of dollars. There are also newer channels of Treasury demand. For example, stablecoin issuers have become increasingly significant participants in the Treasury bill ecosystem. Research published on stablecoin Treasury holdings has highlighted the large exposure of major stablecoin issuers to U.S. Treasury bills. That does not mean stablecoins can replace China. They cannot, but it demonstrates something important. The buyer base for U.S. government debt is constantly evolving. New financial institutions can become significant buyers when the economics make sense, and that brings us to perhaps the biggest misconception about China. People often imagine China as America's banker, but China is not America's banker in the traditional sense. China holds treasuries because those assets have historically provided liquidity, safety, and a place to store foreign exchange reserves. China receives interest, America receives financing. Both sides have an economic relationship, and that relationship creates a strange form of mutual dependence. If China suddenly sold a massive quantity of treasuries, it could hurt the value of the remaining treasuries China itself owns. It could also create upward pressure on treasury yields. And if the dollar weakened sharply, China's remaining dollar assets could lose value in dollar terms relative to other currencies. China could therefore hurt America by selling aggressively, but it could also hurt itself. That's one reason a slow reduction can be much more rational than a sudden liquidation. This is not just an economic issue, it is also geopolitical. The United States and China are strategic competitors. Both countries know that financial dependence can become a source of vulnerability. China therefore has an incentive to diversify. America, meanwhile, has an incentive to ensure that its debt remains attractive to a broad global investor base, and this is why the global reserve system matters. For decades, the dollar has occupied an extraordinary position in global finance. International trade is conducted in dollars, commodities are frequently priced in dollars, global banks hold dollar assets, central banks hold dollar reserves, and U.S. Treasury securities remain one of the world's most important pools of liquid, high-quality assets. Replacing that entire ecosystem is extraordinarily difficult. So even if countries want to reduce their dependence on the dollar, there is no single replacement waiting on the sidelines. The euro is large, but the euro area sovereign bond market is fragmented among multiple governments. China's renminbi is important, but China's capital controls and financial market structure limit its role as a direct substitute. Gold is a reserve asset, but gold does not pay interest. And other currencies simply do not have the same combination of market depth, liquidity, and global financial infrastructure. That is why the dollar can lose some market share without suddenly losing its central role. The more realistic scenario is gradual diversification. And that's exactly what makes China's behavior important. China doesn't have to walk away completely. If China simply becomes a smaller marginal buyer every year, the U.S. Treasury market can adjust. But the adjustment may come through price, higher yields. And those higher yields could become one of the most important financial consequences of de-dollarization. Now consider the situation from America's perspective. The Treasury needs to finance the federal deficit. The Treasury also needs to refinance maturing securities. At the same time, the Federal Reserve cannot simply absorb unlimited amounts of debt. Foreign governments may diversify, domestic investors have limited capital, and the government continues to run large deficits. Something has to balance the equation. There are only a few possibilities. The United States can reduce its deficits, it can increase taxes, it can reduce spending, it can grow the economy faster, it can allow interest rates to rise and attract more private capital, or it can rely more heavily on monetary expansion, which brings its own risks. The easiest solution politically is often the hardest solution economically. Because reducing deficits requires choices that voters and politicians frequently dislike. That is why the debt question ultimately isn't really a China question. It is an American fiscal policy question. China can influence the market. Japan can influence the market. The Federal Reserve can influence the market. Foreign investors can influence the market. But Congress and the U.S. government determine how much America needs to borrow in the first place. And the CBO's long-term projections make the challenge clear. Under current law and its assumptions, debt held by the public rises to approximately 120% of GDP by 2036. The CBO also projects that interest costs rise from about 3.3% of GDP in 2026 to 4.6% in 2036. That means the United States can potentially handle a world in which China buys fewer treasuries, but handling it becomes more expensive if investors demand higher returns. And higher interest costs can create a feedback loop. Higher debt leads to higher interest payments. Higher interest payments contribute to larger deficits. Larger deficits require more borrowing. More borrowing means more Treasury issuance. More issuance can require higher yields if demand doesn't keep pace. And higher yields increase the government's future interest burden. That is the real danger. Not that China owns America's debt, but that the cost of financing America's debt could become progressively more expensive. So who buys America's debt if China walks away? Japan can buy some. European investors can buy some. British financial institutions can buy some. American pension funds can buy some. Banks can buy some. Insurance companies can buy some. Money market funds can buy some. Asset managers can buy some. The Federal Reserve could potentially become more important under certain monetary policy conditions. And millions of individual investors can buy Treasury securities directly or indirectly. The buyer base is enormous. That is why the idea of nobody will buy America's debt is misleading. Someone will probably buy it. The real question is, at what price? If Treasury yields rise high enough, demand can come back. But that higher yield is essentially the market saying, we will lend you the money, but you need to pay us more. And when the borrower is the United States government, paying more means taxpayers ultimately carry the burden through higher interest expenditures. This is why the Treasury market can remain functional even under enormous borrowing needs while still becoming increasingly expensive for Washington. There is another detail worth remembering. Foreign investors have not suddenly abandoned U.S. assets. The latest Treasury data available as of early August showed strong foreign demand. In May 2026, foreign residents purchased $262.8 billion of long-term U.S. securities. Private foreign investors accounted for $246.8 billion of that amount. So the evidence does not support the idea that the world has already stopped financing America. Quite the opposite. The world is still buying U.S. assets. But the composition of those buyers matters. If foreign official institutions become less enthusiastic while private investors become more important, the market may behave differently. Private investors are generally more sensitive to yields, risk, and expected returns than a central bank managing foreign exchange reserves that can make the market more price sensitive. In other words, America may still get its financing, but investors may demand better compensation for providing it, and that could mean structurally higher Treasury yields. This is also why the upcoming Treasury data matter. The Treasury says its next daily release, covering June 2026, is scheduled for August 17, 2026. That data will provide a clearer picture of what foreign investors were actually doing during June. But even then, 1 month's data will not tell us whether the global financial system has abandoned the dollar. Financial trends develop over years. The bigger question is whether the United States can maintain enough demand for its debt while continuing to run very large deficits. And here is the paradox. America's enormous debt is simultaneously a weakness and a strength. It is a weakness because the government must pay interest on it. But it is also a strength because U.S. Treasuries are deeply embedded in the global financial system. Banks use them, funds use them, central banks use them, institutions use them as collateral. Investors use them as a benchmark for pricing other assets. So America's debt is not simply a mountain of IOUs sitting in a vault. It is part of the plumbing of global finance that makes a sudden collapse much less likely. But it does not make the problem irrelevant. The United States can probably survive China buying fewer treasuries. The United States can probably survive foreign investors gradually diversifying. The United States can probably survive higher treasury yields. What becomes much harder is doing all three while simultaneously running enormous fiscal deficits and allowing interest costs to consume an increasingly large share of federal resources. That is the real story. China isn't holding a giant red button labeled American debt. China is one participant in a gigantic global market. If China steps back, the market searches for another buyer. If Japan steps back, the market searches again. If foreign investors step back, yields rise until domestic investors become more interested. And if demand remains insufficient, the price of borrowing rises. Eventually, the question comes back to Washington. How much debt does America actually want to issue? How large should the deficit be? How much interest is the country willing to pay? And how much confidence does the world have that America's fiscal trajectory will remain manageable? Because at the end of the day, America doesn't need China to finance every dollar of its debt. It needs a functioning treasury market. It needs investors who believe the United States will honor its obligations. It needs economic growth. And most importantly, it needs fiscal policy that prevents the debt from growing faster than the economy indefinitely. So if China walks away, don't expect America's debt market to suddenly disappear. Don't expect the treasury auctions to fail simply because Beijing buys less. And don't expect one country to magically replace China dollar for dollar. Instead, expect something more subtle. The buyer base will change. The price of borrowing may change. Treasury yields may adjust. American investors may become more important. Private foreign investors may become more important. And the Federal Reserve may become part of the conversation again whenever economic conditions change. But the bill doesn't disappear. The debt still exists. The interest still has to be paid. And every new deficit still has to be financed. That's why the most important question isn't who will replace China. The more important question is how much will America have to pay to convince the next buyer? Because if the answer keeps getting more expensive, America's debt problem doesn't need a foreign enemy to become a serious economic problem. The numbers themselves are enough. And that is the uncomfortable truth behind America's $40 trillion debt story. China may walk away slowly, Japan may change direction, foreign investors may diversify. The Federal Reserve may buy less, but as long as Washington continues borrowing trillions, somebody has to absorb that supply. And if investors ever decide that the risk has increased faster than the reward, they won't necessarily stop buying American debt. They may simply send America a much larger bill for doing so. That bill comes in the form of higher yields, higher interest payments, bigger deficits, and eventually difficult choices about taxes, spending, and economic growth. So the future of America's debt will not be decided in Beijing alone. It will be decided in Tokyo, in London, on Wall Street, inside the Federal Reserve, inside pension funds and banks, and ultimately inside Washington. Because America doesn't have a $40 trillion China problem, America has a financing problem, and the world is still willing to finance the United States. The question is how long that remains true at today's price. And perhaps the most important question of all is not who buys America's debt after China. It is whether America can eventually reduce its dependence on constantly needing someone to buy more of it.